first time ever.
Warning acts of terror.
We are ready to engage with a two-state solution.
Some of his most senior cabinet members
The drivers of a new economic age.
Hello everyone, welcome back to MND The Futurist. I'm Major Namrata Dhasmana, bringing you a strategic and clear breakdown of one of the most important global economic developments this week. Oil prices have jumped more than $1 per barrel. OPEC Plus has frozen output levels. Ukraine's attack on Russian energy infrastructure has triggered a new supply shock. So today's video will explain why oil prices rose, what OPEC Plus decided, and how the Ukraine-Russia war changed, how much oil is affected, the global economic impact, what it means for India and for Asia, and what will happen next. So let's understand what actually happened. Oil prices rose over US $1 a barrel in a single session. This may look small, but in energy economics, a $1 move in one day signals a major structural shift. Now here are the numbers that I'm sharing with you. Brent crude increased to about 63.38 per barrel, a jump of around 1.6%. Now WTI crude, the US benchmark, climbed to near 59.49 per barrel, also up by almost 1.6%. So two major triggers caused this. One, OPEC Plus kept production levels unchanged through early 2026, creating an expectation of tight supply. Second, Ukraine targeted Russia's Caspian pipeline consortium, that's CPC, disrupting one of the world's major oil export corridors. So this combination of policy restraint plus physical disruption pushed the prices upward. Now, understanding OPEC Plus action, let's break down this decision. OPEC Plus is a coalition of major oil producing countries, including Saudi Arabia, Russia, UAE, Iraq, Kuwait, Kazakhstan, and several others. So they collectively control about 40% of global oil supply and 80% of proven reserves. So OPEC Plus decided no increase in the output for now. Production quotas remain fixed until early 2026. They will not boost supply even if prices fluctuate. Why is this important? Because when OPEC Plus chooses not to increase output, global supply remains tight. Even a small limitation can move prices because oil is a global commodity and tied to transportation, manufacturing, heating, power, supply chains, agriculture, and shipping. So this means even a small change in the supply can shift the global costs, and OPEC Plus has already raised production earlier in 2025, but inventories remained tight in OECD countries, European reserves, Asian buyers, US commercial stocks. Now this tightness created a sensitive market where any disruption causes quick price spikes. Ukraine attack and the CPC corridor. Now this came from the conflict zone. Ukraine conducted an attack on the Caspian pipeline consortium CPC terminal in Russia, Black Sea export route. This is extremely important because the CPC pipeline handles 1.3 billion barrels per day, roughly 1% of global oil supply. exports mainly from Kazakhstan and southern Russia. Even a small disruption here affects tanker loading times, maritime security risks, insurance cost, physical delivery schedules. So although the CPC was not completely shut down, the attack reduced throughput and created new uncertainty. Markets immediately added a risk premium, meaning traders priced in future risk even before disruption becomes severe. This is why oil prices rose quickly. Now, why markets react so fast? Energy markets don't wait for disasters. They react to signals. Three things happened at once. First, OPEC Plus signaled supply discipline. No extra barrels coming soon. And three, inventories already low. Ukraine signaled growing attacks on Russia energy. CPC is a critical artery. One attack raises the possibility of more. Demand remains stable, especially from Asia. China and India remain the strong buyers. Aviation and shipping demand has also recovered. So the market saw supply limited plus risk increased plus demand stable, leading to price rise. So this is pure market psychology backed by numbers. Now let's understand how big the global impact is. Let's first quantify the current landscape. Global oil demand around 102 million barrels per day in 2025. Asia contributes over 36% of global demand. India and China are major imports. So the global oil supply tightness is there because OPEC plus holding supply, US shale growth showing sanctions on Russia, instability in Middle East routes, even a 1% disruption from CPC creates the imbalance. So the market sensitivity, when supply is tight, a 1% cut can move prices by 1% to 3%. A geopolitical event can add $1 to $3 per barrel premium. A pipeline attack can influence tanker insurance. A production freeze can impact forward contracts. This makes every small event globally visible. Why OPEC Plus is holding supply. OPEC Plus decisions are often misunderstood. They are not just economics, they are strategic. OPEC Plus wants to prevent oversupply, keep oil revenue stable, protect national budgets, counter non-OPEC producers, avoid price collapse like 2014 or 2020. So for example, Saudi Arabia needs oil at 78 to 81 per barrel for fiscal stability. Russia needs above 70 to manage wartime expenditures. Gulf countries depend on oil for 70 to 90% of revenues. By holding output steady, OPEC Plus ensures controlled global supply, stable prices, stronger influence, a tighter market entering 2026. So this is why their policy decision matters for the entire world. Now what is the impact on India? India is one of the world's biggest oil importers. Now we import 85% of its crude. Every $1 increase adds roughly 10,000 crore per year to the import bill. Every $10 jump increase the trade deficit significantly. And what higher prices mean for India? Higher petrol and diesel costs, higher transport and logistics prices, inflationary pressures, higher government subsidy burden, increased cost for aviation fuel, impact on manufacturing and supply chains. And what are the other pressures? Strong United States dollar makes oil more expensive. Payments to Russia under sanctions create currency risk. India may have to diversify away from discounted Russian crude. This situation forces India to accelerate renewable energy push, strategic petroleum reserves, long-term supply contracts, and more Middle East diplomacy, increased investment in biofuels and LNG. So what is the impact on this entire global south? Many developing countries face a similar pressures. Pakistan, Sri Lanka, Bangladesh, several African economies. Higher oil means higher electricity costs, costlier fertilizers, higher food prices, lower foreign exchange reserves, and higher national debt, slower GDP growth. So for fragile economies, even a small oil spike can become a national crisis. What can be the geopolitical impact? Oil is not just economics, it is geopolitics. This price increase reflects four deeper trends. The war in Ukraine has entered energy infrastructure. Pipelines and terminals are now the targets. OPEC Plus is asserting global influence. By controlling supply, they control global inflation. Global trade routes are under pressure, especially Black Sea, Red Sea, and Middle East choke points. Energy markets are more fragile than before because renewable transition is slow. Global supply diversification has not matured yet. Political risks are rising. So all these factors combine into long-term volatility. So what next? Some top triggers to watch. First, more Ukraine attacks on energy infrastructure. Any hit on timelines, refineries, or export terminals may quickly raise prices. OPEC Plus February-March 2026 meeting. If they announce production cuts, prices can jump further. Third, US shale production trends. If shale slows down, OPEC Plus gains more power. Fourth, China's economic activity. If China's demand rises by even 3 lakh barrels per day, it affects the global balance, maritime security in Black Sea and Middle East. Shipping risks add insurance costs, which raises the price. Sixth, global economic conditions. Recession fears can lower the demand. Growth can raise it. Oil rising by $1 per barrel may look like a small headline, but it is actually a signal of tightened supply, geopolitical tension, strategic OPEC Plus control, fragile global demand, supply balance. This price move reflects a deeper trend. The world is entering a more volatile and unpredictable energy cycle where geopolitics and economics are completely intertwined. So for countries like India, the global south and Asia, this volatility is not just an energy problem, it is a strategic challenge. And as future conflicts, market decisions, and global demand evolve, oil may continue to behave like a geopolitical weapon. That's all from my side in this video. Thank you for your time in watching it. This is Major Namrata Dhasmana bringing you strategic clarity in complex global issues. See you in the next episode of MND The Futurist. Jai Hind and Jai Bharat.